Buying a home is one of the biggest financial decisions you'll make, maybe ever in your life. But do you know how mortgage interest actually works? Turns out most people don't. And if I wasn't a loan officer, I probably wouldn't understand this either. So in this video, I'm going to break down the basics of mortgage interest and show you how it can impact your overall loan cost. Grab a pen, grab a paper, because it's going to be a lot of information, but I promise you, I'm going to make it as simple, easy, as fun as possible. So mortgage interest is the cost of borrowing money to purchase a home. When you take out a mortgage loan, you will be charged interest on the amount you borrow. The interest rate is expressed as a percentage of the loan amount and can vary based off a lot of factors, such as your credit score, the loan term, and even current market conditions. Yes, the current market conditions can impact the interest rate that you're going to pay. So the way mortgage interest works is that it is calculated based on the outstanding balance of your loan. So each month, as you make your mortgage payment, a portion of that payment goes towards paying down the principal amount, while the other portion or the rest of it goes to paying down the interest, or goes toward paying interest. So think of it like this. You have your one loan amount, right? The loan balance or whatever. You make your payment towards it. Now your payment gets split into two separate portions. Part of it goes to paying the interest, and the other part goes to paying down the principal balance, so the amount that you actually borrow.
Show me the money.
Does that make sense? If it doesn't, don't worry, because I'm going to give you an example. So, for example, let's say you have a mortgage amount of $200,000. Yes, you're probably like, Malcolm, where the heck am I finding a house for $200,000? But just bear with me, all right? Now, let's say your interest on this loan is only 4%. Yes, I know interest rates are much higher than that right now, but do not worry. Let's say you got a 4%. Your monthly mortgage payment, the principal and interest, this doesn't include taxes or insurance, would be something like $955. The first payment might be divided something like this. $300 will go towards the interest. The remaining $655 will go towards the principal balance.
Another one.
The second payment would be calculated on a new lower principal balance. So a slightly larger portion of your payment will go towards paying down the principal. I hope that makes sense. So as you're paying down your loan, more of it over time goes to paying down the principal balance, that $200,000 that we borrowed from, and less of it goes to paying down that 4% interest rate, because interest gets taxed on top of the loan amount. Does that make sense? So as we go, smaller portions are going towards the interest. Over time, as you make your monthly mortgage payment, as you're paying it down, the principal balance also decreases, and that means less interest will be charged each month because your principal balance, the main $200,000, is going down. This is because interest is calculated based on the remaining balance of the loan. So as you pay it down, the interest gets charged less. As you pay off your mortgage, a larger portion of your monthly payment go towards paying down the principal. So the more you pay on your mortgage, the more goes towards your principal balance and less towards interest. Now, eventually, your mortgage is going to be paid off in full, and you'll probably be like, oh, I'm finished. So that's where we all hope to get eventually one day. But as you can see, mortgage interest can have a significant impact on your overall cost of your home loan. And understanding how this works can help you make informed decisions, like when you're choosing a mortgage and how much money you want to save or put down. And in the long run, by paying attention to this, it can help you. It can help you because you're making extra payments now towards the balance, and maybe you're just refinancing it when it makes sense for you. So you can maximize the amount of money that you save and minimize the amount of interest you pay and get closer to owning your house outright. Now, make sure you hit that subscribe button or the follow button so you can get notified when I do another mortgage video. Over and out.